Who hasn't heard of Warren Buffett? Consistently ranked first on Forbes' list of billionaires. His net worth was projected to be $80 billion as of October 2020. He is also best known as one of the world's most successful investors. And as a consequence, Warren Buffett's investment strategy has become legendary. Buffett is a firm believer in several fundamental ideas in an investment philosophy widely followed around the globe. Therefore, what are the specific factors that contributed to his success? Please continue watching to discover more about Buffett's investing strategy and how he's built such wealth. If you are new to our YouTube channel, please subscribe and click the notification bell to avoid missing new content. Dinero Association will regularly add videos to keep you updated on the latest in business and finance. 3 Investment Rules for Beginners by Warren Buffett. While it may seem to be a good idea to invest in new technology or a firm, investors should exercise care and be mindful of the hazards involved with chasing possibilities they do not entirely understand. Number 1. Piece of a business. Buffett was not born into a family of investors. He acknowledged that despite reading several financial books as a youth, he could not profit from stocks. However, Buffett's fortunes altered dramatically after reading Ben Graham's classic, The Intelligent Investor. The book's central idea is to approach each stock transaction as if it were a purchase of a piece of a firm and to avoid getting sidetracked by stock price changes. Buffett credited this investment strategy with his ultimate success. The persistent moat heavily influences Buffett's financial selections. A moat is essential for protection if a business is compared to a castle. An economic moat is a term that refers to a firm that can defend or even define its market position. Market and pricing supremacy are required for this technique to succeed. For example, Berkshire Hathaway's insurance businesses have a float generated by premiums later in claims. This float is just 2.2%, which is much less than a regular treasury bill rate. Buffett prefers to invest in long-term enterprises that are not vulnerable to regular industry change. A moat that must be constructed continuously will ultimately become non-existent, he stated in a 2007 shareholder letter. Number 2. Margin of safety. When Buffett assesses a potential investment, he wants the value at his entry price to be far less than his company's estimated worth. The gap between the two values is his margin of safety, which reduces the magnitude of losses if his business analysis or assumptions are incorrect. The margin of safety approach comes down to obtaining more value than you spend, said Charlie Munger, Buffett's partner, once said. Buffett also advocates for a strategy of economic moat creation that focuses on expanding into new areas. This creates a blue ocean devoid of competition. For instance, Alexion Pharmaceuticals made Solaris, a drug that treats a rare illness known as atypical hemolytic uremic syndrome. The corporation was allowed to market the treatment at a premium price after regulatory clearance, even though a small number of patients used the drug. What is the rationale behind this? A lack of rivals? Since 2007, the company's stock has increased roughly 1,605%. Another technique for establishing a moat is to deliver a superior service or product to rivals. MySpace, for instance, was more prevalent in 2006 than Google and Yahoo Mail. Within 15 months of being acquired by Google, MySpace's monthly revenue climbed from $1 million to $50 million. By June 2009, Facebook had surpassed MySpace in popularity in the United States. In this instance, MySpace pioneered social networking, while Facebook benefited by being the second to do so and perfecting the idea. Number 3. Circle of competence. Buffett feels he must invest in companies he is familiar with. Berkshire Hathaway's portfolio is primarily devoid of technology companies since he doesn't comprehend it. When Google contacted Buffett before its IPO, for example, he declined because he did not see how the firm would remain profitable and competitive. While he lost out on a potentially lucrative investment, the broader picture illustrates his choice to stay away from a risky business. The dangers of pursuing new developments. While investing in new technology or a firm may appear beneficial, investors need to exercise caution and are aware of the hazards involved. One example of this is the current rush to invest in blockchain technology. Bitcoin or BTC hit a high of $19,783. Its value, however, plummeted below $7,000 in March 2018. Critics of blockchain technology argue that investors can't be rational if an item can't be valued. Furthermore, they feel that having faith in technology has little to do with making significant financial judgments. They also claim that owning Bitcoin does not grant individual ownership of blockchain technology and that the motivation to buy Bitcoin stems from FOMO, fear of missing out. Despite these warnings, a substantial number of early investors put their money in and lost everything. Buffett's stance on blockchain technology aligns with his philosophy of only investing in what he understands. In terms of cryptocurrencies in general, he can almost guarantee that they will end in disaster, regardless of when, how, or what else happens. It's not inevitable. Warren Buffett's investment theories may be applied to entrepreneurs' firms in 3 ways. To begin, individuals should not join a business just for the sake of making money. Passion should be their driving force. Second, they must recognize the importance of cooperation and culture, since a business success depends on people collaborating. Finally, rather than avoiding failure, entrepreneurs should embrace it. Successful investing requires an acceptance that not all investments will pay off. Furthermore, not every business venture succeeds. A compelling notion and a feeling of purpose should drive investing in entrepreneurship. By embracing the investment mentioned above, investors and entrepreneurs may increase their capacity to see red flags and avoid adverse outcomes. As you've seen, Buffett's investment strategy is akin to a bargain hunter's purchasing method. It represents a down-to-earth, realistic mentality. Buffett maintains this mentality in other parts of his life. He does not live in a mansion, collect automobiles, and go to work by limousine. While value investing does have its detractors, whether you agree with Buffett or not, the evidence is in the pudding. Please share and like this content and let us know what you think by typing your comments below. Keep your notifications open, and I'll see you on our next video.